Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures in the green amid the shortened trading week as investors digest the latest Fed speak and geopolitical risk. Fed Governor Chris Watling saying he supports holding rates steady as the central bank monitors for progress in its inflation battle. Investors will get the latest insight into the Fed when the meeting minutes are released tomorrow, Wednesday. Meanwhile, global stocks getting a boost today as Russian and U.S. officials, they meet to negotiate an end to the 3-year war in Ukraine.
Plus, investors are awaiting earnings results from Walmart, Alibaba, and more this week. Tariffs and inflation are going to be in focus for Walmart City, expecting strong holiday sales to help the company beat estimates. And trade policies will also be in focus for Alibaba. The Chinese e-commerce giant will likely face some questions on the planned imposition of U.S. duties on small packages, as well as its guidance on artificial intelligence rollouts.
And a scary scene in Toronto on Monday as a regional Delta flight flipped out of control after landing in windy and freezing conditions. All 76 passengers and 4 crew members survived the crash, but 15 were injured. Delta CEO Ed Bastian says the company is working to confirm the details and will share the most current information on the incident as soon as it becomes available. The incident continues a bad start to the year for air safety in North America, shares of Delta dropping after the crash. Wall Street is feeling bullish, according to the latest fund manager survey from Bank of America. Cash levels hit their lowest level since 2010 as equity investors rotate their holdings into bond-sensitive sectors. Joining us now, we've got Yahoo Finance's Josh Schaefer. Josh, there were some elements of this survey that remained a larger trend, but perhaps some new elements as well.
Yeah, Brad, I mean, interesting. So we've been talking about low cash levels in this survey for a while now, but for cash levels to fall to 3.5%, that's where they're seeing their allocation to cash, these fund managers. Lowest level we've seen in about 15 years. And really, guys, what that tells me is sort of the market action we've been talking about over the past couple of weeks, which is people want to keep their money in the market. People want to be in stocks right now, whether it be perhaps maybe different stocks, different sectors than we've been talking about over the last couple of years. But it seems like there's a clear bias here from investors to keep their money in the market, and that was one of the broader takeaways. Also another chart here, guys, pointing out that fund managers still see the Magnificent Seven trade as the most crowded trade. Again, when we think about the action over the last month and a half, if I think Mag 7 is the most crowded trade, I'm probably going to put my money somewhere else. And that's been the market action that we've seen sort of to start this year, right? Has been people allocating in other areas, perhaps outside the Mag 7.
And then to that point, just in terms of the expectations, where they're expecting to see some of that outperformance too.
Yeah, so overall, some fund managers pointing out that they think they're going to see more outperformance outside of U.S. equities, which was pretty interesting, Seana. So they pointed to global equities. They also pointed to gold. We know gold pushing higher this morning, right? Global equities have actually been outperforming the S&P 500, depending on what you look at. We're looking at a chart here of just the emerging markets ETF from BlackRock. You put that over the S&P 500. Emerging markets up about 6%, S&P 500 up about 4% to start this year. Seeing that trend a little bit this morning too. EEM outperforming a little bit compared to the broader market, at least in pre-market trading. But there's been a little bit of a shift here of, okay, European stocks are super undervalued. Most people would argue that. Maybe growth is a little bit better than expected there. Maybe that's an opportunity space when you think about the US and the economic narrative we're starting to look at here, which is, were we too bullish on overall economic growth going into this year? And does it come down a little bit? And U.S. stocks are overvalued, right? So it becomes a discussion of just where do I think I can get a better return? But there is sort of a growing case for maybe a little bit less Mag 7, a little bit more of the other U.S. equity space, and then also maybe there's some opportunity in the rest of the world here. You guys mentioned Alibaba earnings later this week, but that's a stock that's been really hot, and people have been talking a lot about China stocks too.
You mentioned the risk on appetite here, which is clearly at play, and it shows through some of the charts that you've been running through. What type of perhaps risk does that also put on the table for the broader markets, especially as we're trying to figure out, all right, if 6,600 is perhaps one of the average consensuses that we're seeing out there, the chop that we would see en route to that 6,600 S&P 500 target
Yeah,
as well.
yeah, this is something we've been talking to strategists about too, Brad. We're talking about people want to stay in the market, but there's a lot of money moving around into different areas. So if you don't have sort of that Mag 7 leadership, maybe that's why you don't get your 20% return in the S&P 500, right? There's a lot of stocks outperforming the index right now. There's almost half of the index is outperforming. The companies within it are outperforming the index. But there's different names, right? And they're smaller names. They're not your large names. So you're starting to see a little bit of a shift in terms of where the outperformance is coming from. And I guess to put it, as they like to say it is a little bit of a stock picker's market right now. So if you're into that, there's some opportunity out there for once, which we haven't seen over the last 2 years.
Yeah, and Josh, just going back to what you were saying a moment ago, just in terms of some of the catalysts that investors do see on the horizon, and this really speaks to the fact of some of that leadership may be coming from outside the Mag 7, even outside of U.S. equities. But in addition to China, we talked about in second place, or the second biggest driver maybe, is AI productivity, right? And then the third is the Fed cut. It's just interesting to see just in terms of where the Fed now sits in the overall macro investment theme, and very much just in terms of the fact that we've been talking to strategists day in and day out, and they're saying just in terms of the fact that the Fed isn't expected to cut too much this year, just one cut maybe before the end of the year, potentially even for no cuts. It's not so much of a concern maybe for the markets as we initially would have thought going into this year.
Yeah, no, and we've priced out, so we went from 2 cuts. We basically priced out one of those cuts last week, sort of teetering between 1 and 2 right now, but the market hasn't been overly shook by that, right? Stocks have been pretty resilient through each piece of data. You guys mentioned Fed minutes coming out tomorrow in a pretty quiet economic week. That will be one of the bigger releases of the week. And I think the key question for the Fed minutes and for the market will have from Fed minutes is, does the Fed still have an easing bias? Right now, we are under this impression that if the Fed were to move in 2025, it would be reducing rates. There is not a lot of discussion that their next move would be a hike. As long as there's an easing bias, that's part of your bull case for stocks, and that's why stocks have done okay. If we start to think, they're really worried about the tariff story, and they're really worried about where inflation could head at the end of 2025, and there's real debate about hikes, that's when I think Fed might be a higher risk on it. It comes up from number 3 to maybe number 2, number 1, because rates staying here might be okay. Rates going higher, that's a different story.
Certainly. All right, Josh, great stuff. Thanks so much for breaking that down. Well, while investors are showing a greater willingness to take on risk, our next guest is warning that the U.S. bull market is due for a pause. Joining us now, we want to bring in Chris Watling. He's Longview Economics global economist and chief market strategist. So, Chris, talk to us just about the fact that why you think the U.S. bull market is due for a pause.
I mean, well, multiple reasons, but primarily, I mean, the bull market in the States rarely goes more than 2.25 years without a big break. I mean, it doesn't have to be a bear market, but certainly a big break, a multi-month pullback. Maybe it's 10%, maybe it's a little bit more than that. And you can see that if you look at the history of the S&P 500 all the way back to the 1970s, it almost never goes longer than that without a meaningful crack. And you can see the signs of it. It looks tired. I mean, as we were just hearing, there's been rotation away from US equities. Other parts of the world are doing a lot better this year. And also it looks to us that not only is the bull market looking tired from a technical perspective, but I think the US economy is going to struggle in the first half of this year. The sort of enthusiasm about the US is really widespread and strong coming into this year. But actually, when I look at Trump's economic agenda and the way he's playing it and the order of that agenda, I think it's going to be negative for growth in the first sort of part of that agenda, perhaps the first half of this year, maybe first 3 quarters, and then it gets much better for growth going on out. So I think there's a bit of a growth issue in the US relative to expectations. It's going to be softer. I mean, I emphasize the relative because, of course, growth, it will still be there. And then the bull market looks tired. It needs a break, and we're getting sector rotation globally that doesn't favor the US large cap. So it's kind of a mixture of technical factors and macro factors that are concerning us at this juncture.
Yeah, you mentioned some of the pressures that could be induced because of policy, but then on the backside of that, on the rebound, would it just be relief that perhaps the policy that's talked about, perhaps beginning as negotiation and then starts to get into actually how it plays out and perhaps backing off of some of the worst extents of that negotiation, that it's just relief that it's not as bad as it could have been, and then we start to get more clarity around how companies could operate in that macro?
Well, we're certainly going backwards and forwards on tariff debates, and no one really knows exactly where we're going to land on that. Although I have to say, I still think that the playbook's pretty clear for Trump and his team, and it's been written down in a number of places. And the tariffs playbook is simply one, part of it's transactional, perhaps with more of the allies, and part of it is raising revenues and creating a fair international trading environment. But there's more to it than that. I mean, the reality is Trump's got to create fiscal space to do tax cuts, which means they have to cut on the fiscal side up front, cutting government spending, as we're seeing with Musk's Doge. And in fact, this is already happening. As of day one from Trump's new presidency, the cutting began and the freeze on government hiring began. And in fact, if you look at last year, about 70 or 80% of non-farm payroll job growth in 2024 was either direct government or indirectly related to the government. So, the private sector isn't creating as many jobs as it normally does. The labor market's quite soft. The economy's been driven by fiscal strength under Biden, and that fiscal surge and that fiscal stimulus is going away, at least temporarily. So I think that's the point. Tariffs is clearly a negative, but also that fiscal support is no longer going to be there for the US economy in the first sort of half, 3/4 of this year. And that I think is where the economy starts to struggle, because under the surface, the housing, the manufacturing, they're all quite weak, and they're manifesting the effects of tight money. And so I think we need more monetary support for this economy in the US in 2025, because we're going to get less fiscal support is really the net. And tariffs, of course, add to the disruption on top of that. So that's kind of how we're seeing it. There are some challenges relative to expectations for US growth, I think, in the near term.
So, Chris, then given that, where is the opportunity?
Well, the opportunity is overseas because, we're in a global rate cutting cycle. Now, I know we priced out a lot of the cuts in the States, but the rest of the world is still cutting rates. And I think the US will come back to the party if we get this soft patch in growth. So we're looking for a cyclical upswing later this year. And I think that's what the market is starting to think about as it rotates to Europe. And in fact, it's rotating a little bit to Asia as well. I mean, part of the Asian story is the sort of tech, Chinese tech, DeepSeek story. But part of it is rate cuts, and particularly in Europe. You look at the banking sector, the banks have done remarkably well. If you look at the southern European economies, they're doing terrifically. Their stock markets, the Italian stock market keeps making new highs. So does the Spanish market this year. So it's not always one-way traffic to the States. At the end of last year, everyone thought it was American exceptionalism and all that. And the Mag 7, of course, they've had a terrific run. But as I said, I think when I came on your show August last year, every man and his dog owned NVIDIA back in August last year, and NVIDIA's done nothing since then. Neither's Microsoft. So, the world is rotating. The opportunity is in cyclical spaces over the next sort of 6, 12, 18 months. So I think the market's getting the sort of sniff of this, and it's starting to rotate, and we're starting to unwind those extremes in positioning that favored the US at the back end of last year, and everyone disliking Europe, for example, at the back end of last year. That's starting to change.
Yeah, some people have even named their dogs after NVIDIA. Lastly, while we have you here, Mag 7, as you were talking about where we could see opportunity for investors to either take profits right now or just lock into that trade long term, if they were to take profits at this juncture, where do you think some of that money gets reinfused back into the market?
Well, I think mid and small caps in the States can do well. They're going to enjoy the deregulatory environment as it comes about. They're not going to enjoy the initial cuts in government spending, but they're going to enjoy the lower interest rates. I think you're going to start getting a credit cycle in the US later this year. The deregulation agenda, all of that helps small business sector. And along with that, home builders as well. So I think small and mid caps plays on domestic economy outside of the large caps will do well. So we like that. We like the cyclical areas of the market. And I mean, of course, you've got to go over this pullback in the US that we think is coming over the first half of this year. But I would use that pullback to reallocate money as I say, the small mid caps, the cyclical areas of the market, and maybe even some of the deeper cyclicals as the market sells off. But certainly the sort of classic consumer cyclicals, home builders and so on, I think will do well as we price back in rate cuts into the US curve and as the US large cap market comes off and sets us up for a cyclical recovery in the second half of the year.
Chris, thanks so much for taking the time.
Thank you.
An update on a developing story in Canada. A Delta Airlines jet landing at Toronto's Pearson Airport crashed into the tarmac and flipped onto its roof on Monday afternoon. The flight taking off from Minnesota arrived in Toronto around 2:45 p.m. Eastern Time amid blowing snow, strong winds reaching 40 miles per hour on the ground. All 80 people on board the flight, 76 passengers and 4 crew, were evacuated and survived the incident. 18 people were injured and taken to the hospital, with none believed to be in life-threatening condition. Canada's Transportation Safety Board is leading an investigation, with the U.S.'s National Transportation Safety Board putting together a team to assist. The cause of the crash is not yet clear, according to officials. Toronto Pearson's fire chief gave this update after the accident.
This is an active investigation. It's very early on. It's really important that we do not speculate. What we can say is the runway was dry and there was no crosswind conditions.
Delta Airlines CEO Ed Bastian released a statement saying, quote, "The hearts of the entire global Delta family are with those affected by today's incident at Toronto Pearson International Airport." This was the 4th major aviation accident in North America this year.
All right, coming up next on Morning Brief, we're going to count you down to the opening bell on Wall Street with stocks set to open in the green. Plus, we'll check in on shares of Southwest, the company planning to lay off about 15% of its corporate workforce. And we get a preview of what to expect from Walmart results as the retailer reports later on this week. We'll discuss that and much more coming up next.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Southwest, cutting 15% of its workforce in its first ever mass layoff as the airline continues to cut costs. The company expects the cuts to save $210 million this year, $300 million in 2026. And the cuts will affect about 1,750 jobs, including some senior leadership roles. We've been keeping tabs on shares of LUV. They are up right now. This is typical in terms of the stock reaction that you see when some of these corporate-wide restructurings and layoffs are actually rolled out here. Some of this had started to already be communicated by Southwest and how it was looking across its entire cost basis here. And then you also think about some of the activist pressure that certainly has elicited some of these actions too.
Yeah, it certainly has been a year of change, I think it's safe to say, for Southwest, just given the fact that they had the involvement from Elliott Management, given the changes that we've seen to their board, given the changes that we've even seen to some of the structure there of their business in terms of their offerings. They're going to start offering premium seats, more leg rooms. They started red-eye flights. Certainly a number of changes being enacted in Southwest. But the reason why this is such a big deal is because this is the first mass layoff that has been announced at Southwest. So given the significance of that, given the fact that it's 15% of corporate positions, including senior leadership and directors' role, really just shows, I think, some of the pressure that Southwest has been under, continues to be under, in order to turn around the business. They are doing everything they can to cut costs. We've talked to CEO Bob Jordan a number of times about this. He released this statement saying that we are at a pivotal moment as we transform Southwest Airlines into a leaner, faster, and more agile organization. He has talked about that time and time again to us here at the desk at Yahoo Finance following earnings results most recently there from Southwest a few weeks ago. So again, they are making improvement. They are making some steps. They have taken some steps in the right direction. But again, when you take a look at the stock performance and stack it up against some of their bigger competitors within the space, clearly they have still underperformed and more changes are needed at this point.
Yeah, absolutely. You can see even more of the details in the SEC filing from Southwest this morning here. But again, we'll be tracking shares in reaction to this throughout the rest of today's trading session.
All right, let's take a look at a couple of chip makers. Broadcom and Taiwan Semiconductor reportedly considering deals with Intel that would split the chip maker's business. This is according to a report out from the Wall Street Journal. Now, Broadcom has interest in Intel's chip design business, while TSMC is looking at the company's factories. The talks are in preliminary stages. You're looking at share reaction. Intel off the highs here of the morning, now up just about 4% here in pre-market trading. You have Broadcom just below the flat line. You have TSMC here up nearly 1% ahead of the open. I was taking a look at some of the initial reaction there from the street. Cantor Fitzgerald coming out saying that the clear strategic winner here in this is TSMC. The company might become the sole leading edge foundry provider worldwide. So they're seeing that as a big takeaway here from this report. And again, Needham also saying that Intel Foundry is operating at a huge loss and would likely not have a buyer if TSMC does not step in. There's lots of questions about who potentially would be interested if this, in fact, was a route that Intel were to seek. And again, you are seeing some reaction here in shares ahead of the open with Intel up just about 4%.
Yeah, the larger question here, too, for me is when you think about what the Trump administration has already said in its own stances about advancing American businesses, and especially with the broader reliance that's already been made known and well documented on TSMC and their fabrication and wafer production as well here. The question of what TSMC would have to go through in order to get this regulatorily approved in this administration right now, even as we talk about some of the deregulation and deal making that was bolstered coming into the election and then thereafter, as Trump was looked at as a pro-business president. Ultimately here, I think, with the reactions that we've seen from the Trump administration and what they would potentially support and not support, TSMC getting this factory and manufacturing footprint of Intel, which had already been earmarked for billions of dollars from the government to bring a lot of these factories online. I think that's very much up in the air, and we would have to see exactly if this is one of those deals that would still get the kind of, the seal of approval going forward. But that's one of the larger implications for me, at least thinking about the billions of dollars that Intel had been essentially guaranteed to build up its own factory production too. Mm-hmm. Also here, let's talk about Baidu. This has been an interesting one to track here pre-market. Shares of Baidu, they are lower right now. At least they were by about 4% earlier, and they are right now, reporting a smaller than expected drop in the fourth quarter in that revenue, and the Chinese tech giant doubling its profit as its AI business offsets weak advertising demand here. You're seeing shares lower by about 4.5%, as we were mentioning here. And one of the huge things that they also called out was the pivotal year in their ongoing transformation from an internet-centric to an AI-first business. That's how they're looking at this transformation, according to the CEO, Robin Li, and then also saying that AI cloud gained momentum fueled by broad market recognition of some of the full-stack AI capabilities that as part of the statement in their release this morning.
Yeah, there's a lot of focus in this release and on the street taking a look at the quick reaction on AI and the opportunity that lies ahead. But when you take a look at the stock reaction this morning, you're taking a look at the fact that shares are under pressure. A lot of that is because of the fact that they did see revenue slide just a bit. Now, it was smaller than expected revenue drop, but still, revenue did shrink just about 2% to 34.1 billion won in the most recent quarter. So again, a bit concerning here from the street when you take into account some of the more macro pressures that the company is up against. So yes, they are dealing with a weakening consumer within the Chinese market. They are dealing with some headwinds here just in terms of rising geopolitical tensions between the U.S. and China. That, of course, is among the headwinds that faces Baidu here in the immediate term. But again, when you take a look at maybe the longer term horizon, there still is a lot of optimism. You're seeing that in the commentary out on the street this morning. A lot of that obviously surrounding the AI business and the growth potential of that division.
Yeah, the AI division needs to grow quickly for this company in order to offset some of the declines that they did see in the streaming platform. That was a decline of about 14% in revenue, and then additionally on the online marketing revenue, that declined by about 7% during the quarter.
All right, we'll keep it right here on Yahoo Finance. Much more coming up ahead. We've got the opening bell when we come back.
Welcome back, everyone. You're taking a live look at the opening bell at the New York Stock Exchange. Prudential celebrating 150 years. Wow, where were you when? And yeah, if you were around, then my goodness, good for you. And Triller also celebrating the opening bell at the NASDAQ. There you're taking a look at some funfetti popping off in the air in Times Square. All right, let's take a look at where we open here on the first trading day of the week here, holiday abbreviated trading week. You're seeing the Dow right now open up flat, but to the downside by about, we'll call it 0.04%. The NASDAQ composite, that's calibrating here this morning. We did see some gains coming into the start of today's trading activity. The S&P 500, you're seeing that start off the day fractionally higher by about 0.1%, and the NASDAQ looks like it's calibrating higher by about 0.2%. We'll round that off too. Let's take a look at some of the sector activity. 11 sectors in the S&P 500. We've got them loaded up here for you on the screen. It seems like we've got more gainers than decliners here, almost about as split as you can get. It's 11 sectors, so we can't split one of them down the middle unless one of them is flat. And financials trying its best to do that. But anyway, that's flat just barely to the upside here. Ultimately, you got staples pulling up the caboose. You got technology leading right now. Let's take a look at a little bit more of that technology landscape with the NASDAQ 100. My goodness, if we could fit the entire NASDAQ composite up here, you would have to do a lot of squinty activity to really get a full picture of some of your favorite stocks. But anyway, speaking of some of your favorite stocks, NVDA, that starts off the day higher by about 2.25% right now. You're also taking a look at Microsoft, Apple, Amazon. We've got some flattish to the upside moves there, and then Meta. My goodness, what a run Meta had, but we'll see ultimately. Let me just populate this chart for year to date. Why not? Just so you can get a, all right, it's not going to populate for me. There you go. Jared Blickery helped me out there. I could see him clicking the touchpad out there. So anyway, there you're taking a look at Meta Platforms up 25% year to date. Speaking of the aforementioned man himself, Jared Blickery, let's get on over to him for a deeper look at what's looking. Thanks so much for the assist, Jared.
Thank you. I'll take the credit, even though I didn't touch anything. The Wi-Fi Interactive has a mind of its own some mornings, and let's hope it's benevolent today. S&P 500 and the NASDAQ coming off record weekly closes, not on the daily basis, but for the week. And you can see here we have this nice cup and handle pattern that it looks like it's trying to break to the upside. I did some seasonality work last week, and I would want to highlight that the back half of February, which we are in right now, can have a little bit of bearish seasonality. So that might be a headwind. But the important thing to remember is we are right by record highs here, and that would be the fourth day to the upside for the NASDAQ. Want to take a look at the 10-year T-note yield as well. That is up just a few basis points, and we'll see if we can get that to populate. There we go, up 5 basis points. And the US dollar also jumping after 3 down days. You can see it's in the short-term downward channel there, not making any headway to the upside or the downside. So we move on. And let's take a look at the sector action one more time. Tech is still leading. We have a bunch of defensive sectors lagging. That would be staples, healthcare, communication services not. There we go. Real estate is another one, so we'll take that. And if we go over to the NASDAQ one more time, I want to show you Meta. Now, Meta is in the red right now, but what it has been doing the last week or so, 2 weeks, is it has been gapping down, and I'm going to talk about the gap in about 30 minutes here, but has been gapping down, then it is closed in the green, with the result that year to date it is up almost 30% right now. We'll see if this populates, but 30% and 21 days would be the new total if we can get that there. NVIDIA too, NVIDIA surging another 3%. It is now within 5% of its record high, so that's something we want to track as well. We have its earnings approaching. And then I got to show you what's going on in China. China has just been this juggernaut day after day. It has been showing a lot of strength. Not all these names. You can see there's a lot of red on the screen there. But the ETFs like FXI, KWEB, those are all up to 4-month highs right now. And you can see this illustrated with Bob. I'll just show you the 4-day. Maybe we can get that. 13% in 4 days. That is impressive for a large stock like that. I'm going to close with Bitcoin. Bitcoin has been doing a whole lot of nothing for about the last 10 trading days. This is the last 4, but I'll show you the year to date, and you can see how the range has just really contracted here. That just means it's coiling for a breakout. Will it be to the upside or the downside? We will have to wait and see. Back to you guys.
We will wait and see. All right, Jared, thanks so much. Jared just mentioned the strong dollar, the dollar moving higher this morning ahead of another week of earnings from companies including Alibaba, Walmart, and Rivian. One trend emerging so far this earnings season has been that strong dollar, with big tech behemoths to consumer-facing brands mentioning FX headwinds in both their results and forward-looking guidance. Here to break it all down is our very own Alexandra Canal. Ali, what have we been hearing?
Hey, Seana. So we've seen some pretty volatile dollar moves over the past month or so, really since Trump's inauguration, and the dollar has moved primarily on trade and tariff news. It's very sensitive to those headlines. And since the election, we've seen this sharp rise in what's called the U.S. dollar index, again, tied to those expected protectionist policies from the Trump administration. So if we take a look at this index, which measures the U.S. dollar with a basket of 6 foreign currencies, you'll see that around the election in November, we saw an uptick here. Again, we've been steadily climbing into this January high. This was a 2-year high. We've been bouncing around a little bit there, but still over a 6-month period, we're up about 5%. If we take a look at a 3-month chart, we're still up about 1%. But that rising dollar, it has pressured earnings, especially for companies that do most of their business overseas, since that will lead to slower revenue and earnings growth over time due to unfavorable foreign exchange conversions. And to that point, mega cap tech, we think it's invincible all the time, but they actually generate a significant amount of revenue internationally. Apple reported roughly 58% of overall revenue from international sales in its most recent quarter, and the percentage of overseas sales from other Mag 7 players like Alphabet, Microsoft, Tesla, Meta, that came in at roughly 50% or higher for all of 2024. And even Amazon, which only generates about 23% of revenue internationally, that's according to their latest report, they reported an approximate $900 million hit from foreign exchange. And because of that, it's possible the company could experience its slowest revenue quarter in its history for Q1. But it's not just tech companies. Coca-Cola, Johnson & Johnson, McDonald's, all of these businesses, consumer-facing brands, they're feeling that impact. And Goldman Sachs actually predicts that the dollar could appreciate by another 3% over the next 12 months. So perhaps a little bit more pain ahead. Seana?
All right, Allie, thanks so much. Let's stick with the dollar. The greenback strengthening against its peers today as Fed Governor Chris Watling says that recent data supports the central bank's decision to keep rates on hold. But could President Trump's protectionist policies damage growth and also slow the buck's run? Joining us now, we want to bring in Jane Foley, Rabobank's head of FX strategy. Jane, it's great to have you back here on Yahoo Finance. Let's talk about, we are seeing the dollar back in the green here today, strengthening just a bit, but we have certainly seen this move to the downside. I'm curious just in terms of what that signals for you and whether or not this is a start of a larger pullback, more broadly speaking, that we've seen in the dollar.
Well, I suppose we have to give it a little bit more perspective. And if we think about the gains in that dollar index through the fourth quarter, well, really right at the end of September up till I think it was about the 13th of January, that dollar index gained about 10%. And since then, it's down about 3%. So if we look at those figures, well, we could say that this is profit taking, but I think it's a little bit more than just that. So what we had last year, we had those animal spirits. We had a lot of anticipation about the type of growth in the US and the inflation that was going to be brought about by Trump's policies. Now, since early January, that the market's begun to rethink that. Now, if you recall, of course, when Trump threatened tariffs on Colombia and then backed down when Colombia agreed to back down on an immigration issue. Similarly, when the threat of tariffs was used on Mexico and Canada and then back down when a border issue was agreed, the markets realized that the threat of tariffs isn't going to be just about all trade, about putting a tax on US consumers effectively. The threats of tariffs are often going to be used for foreign policy objectives. So the markets have reconsidered the inflationary impact of Trump's policy, which is part of the reason we've had that move lower in the dollar this year.
And so how do you think the Fed will be running its calculus around the impact?
Well, although, you could say, well, surely that's sort of good news for the Fed, a little bit less inflation. I don't think that they are going to be relaxing on that because there probably will still be tariffs. In fact, we still have had tariffs on China, of course, tariffs on steel and aluminium, etc. We are expecting more tariffs on the EU, maybe on Japan, potentially as well. So we are going to get an inflationary impact in the US from tariffs. But the other thing is that if we look at US CPI inflation right now, which is the January reading, that's the latest one that we have, we already have sticky price pressures, core inflation, of course, pushing higher in the US. And that reflects a period before Trump's policies have had a chance to really make an impact. So what we're saying is that, well, because we had stronger data on growth really for the US through the autumn, we're starting off this administration for Trump with quite sticky inflation already, and the Fed is going to have to react to that. So we think there may be one more interest rate cut from the Federal Reserve this year, but maybe not. If we hear more tariff news, well, that door could shut fast, and that would give support to the US dollar.
How much support, Jane?
Well, in terms of the euro, say the euro dollar, we still think that there's a good chance that we could see parity. We're not forecasting below that right now because there is also a little bit of stickiness in European services inflation. So we do think that the ECB is nearing their terminal rate, a couple more interest rate cuts from them. The market thinks maybe 3 and then a pause. So we're not forecasting below parity, but we do still think that we could still have dollar strength. But it really does depend on how quickly some of these policies from Trump do come through.
Jane, as we have a big week here where we're going to be getting some Fed meeting minutes, but we're also going to hear a couple of the committee members who are going to be out making some comments, speaking this week, a couple of them doing it twice. So all of those things considered, what could these committee members say that ultimately kind of reframe the thinking around the number and ultimately perhaps even a reduction of the number of rate cuts?
Well, you're absolutely right. The majority of Fed voters will be speaking this week. So it is something that the market will be paying attention to. Now, the Fed has signaled that they could cut interest rates twice more this cycle. The market is thinking maybe 1 to 2, so maybe a little bit less. Here at Rabobank, we're thinking maybe 0 to 1. And I think the combination of those comments plus, the economic data that we'll be getting in the next few weeks will really help fine tune and frame the market's idea about how much realistically in terms of easing the Fed is likely to do this year.
Jane, thanks so much for taking the time. Jane Foley of Rabobank. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at investor sentiment. Hey, Maddie.
Hey, Brad. Yeah, investor sentiment turning bearish and hitting a record level of bearishness. If you take a look at this chart behind me from the American Association of Individual Investors, a survey that we love to look at, investor bearishness hitting 47%. That's a record high going back to 2023. So what's driving some of this bearishness that we're getting in the market? Well, policy uncertainty is certainly among those top drivers of this bearish sentiment, both in terms of policy from the White House and policy that could be coming from the Federal Reserve. Specifically, though, when it comes to the White House, tariffs in particular, a huge area of uncertainty. 57% of investors surveyed in this same group said that tariffs could hurt growth and increase prices. That's potentially why we're also starting to see a little bit of a rotation out of some of those big tech names. And even U.S. equities in particular, we're starting to see outflows into equities over the pond here. We're seeing Europe stocks in particular outperforming U.S. equities year to date. Also, investors pouring into global stocks with cash levels at record low levels, but 89% of these investors also said that U.S. equities are overvalued. So that could be another bull case for those European equities. Of course, we're going to continue to monitor. This survey in particular is a really good kind of way to gauge investor sentiment, but interesting to see that bearishness hitting a record level, particularly as I mentioned, as those mega cap tech stocks continue to be under pressure, guys.
All right, Maddie, thanks so much for breaking that down for us. Coming up, Walmart kicking off retail earnings this week. We are going to take a look at the biggest things that investors should be watching out for. That's coming up next on Morning Brief. Walmart set to report fourth quarter results on Thursday before the market opens, and analysts are expecting a strong report off the back of a very strong holiday season. Joining us now, let's bring in Corey Tarlow. He's Jefferies Senior Vice President of Equity Research. Corey, it's great to have you back here on Yahoo Finance. Let's talk about what we could hear from Walmart later on this week. Certainly expectations are high. Do you think they will live up to those lofty expectations?
Good morning, and thank you for having me. What I would say is that the answer would be yes. I know expectations are high, but we think that Walmart delivers, very simply. And we think they deliver above expectations. And one thing that we're looking at specifically is this is a global retailer, but we're specifically looking at the US business in particular, which is where our data really gives us an edge. And right now, as we look for the current quarter that they're going to print again on Thursday, current consensus numbers are about a 4% same-store sales growth metric for the fourth quarter. And based on our data, which looks at foot traffic and receipt data, we're actually closer to about 5%. And if you recall last quarter, it was a very similar story where you had a 4% consensus number and a beat by Walmart, but close to 5%, and the stock was up. So we think that 3Q, very similar story plays out here again in 4Q as well.
And so does that mean even more of the strength that you're anticipating among some of the more affluent consumers coming into a Walmart, trading in, as they would call it, to that experience, whether it be at Walmart or at Sam's Club?
Yeah, I mean, 3/4 of Walmart's market share gains have actually come from higher income customers. And this is a $450 billion retailer in the US that's comping up 5%. So it's seeing incremental dollars flow into the tunes of billions. And it has to come from somewhere. And a lot of these higher income consumers have helped to really fuel that growth. And Walmart's always led on value, but one thing that they've, I think, really improved on in the last several years is convenience. With buy online, pick up in store, buy online, ship to home. They now have express delivery. They have even drone delivery in certain markets. And I think this convenience aspect has really helped to acquire and retain a lot of these higher income customers, many of whom are taking advantage of the benefits now through Walmart Plus, which is a relatively new program that the company has. So the combination of all these different things, I think, have really helped to propel their growth and probably even make this growth more sustainable into the future, which is why Walmart's one of our top picks for 2025.
Corey, what about tariffs, though? How big of a risk?
Well, 2/3 of Walmart's business is food, and a lot of that is produced domestically. So we'd actually see more risk in tariffs in other stocks that source more internationally, where exposure to China is a little bit higher. So again, because it's mostly a food business, we see the risk as relatively lower. It's still a risk to numbers, but ultimately that probably just gets passed through in the form of higher prices.
Corey, are they able to do that, though, at this juncture, just given the macro environment right now and given the trading down or trading in, whatever you want to call it, that we have seen from consumers?
I think it will be passed through in terms of higher prices, as I mentioned. But this comes with the caveat that, yes, they might pass through higher prices as a result of tariffs, but their prices are still lower than just about everywhere else. In fact, we do a weekly survey of Walmart's pricing relative to other retailers, and the value gaps continue to be very, very wide. And just as one example, we take the look at private label price gaps. So a brand like Great Value, which is Walmart's private label brand, versus a name brand. And historically, those price gaps used to be about 25%. And now they're getting close to about 50% in certain categories. So I think this just illustrates to you that, yes, while tariffs could result in higher prices, you're still going to see a much more significant value gap in Walmart's offering relative to other retailers, which is going to make Walmart's proposition that much more attractive going forward, in our view.
Corey, is Walmart still the name for the best returns for shareholder value in the retail landscape right now? Over the past 2 years, we're taking a look at this chart. It's up 112%. Hard to believe that it's possible to add on to, or not add on to, but at least duplicate that effort once again.
It's a great question. It's one I think a lot of investors have tried to wrap their heads around. I was just marketing across 4 different cities and met with over 50 investors over the last week. And I think this is something that a lot of people are trying to better understand and to get comfortable with, which is the growth that we've seen in Walmart and what that portends for the growth going forward. And our belief is that if you aggregate all the potential benefits that Walmart's likely to see from the scaling of higher margin revenue streams like advertising and fulfillment services and the addition of automation and AI into their business, all of that should really continue to benefit the P&L. And the last thing here is that we're recommending to buy Walmart, but the stock's at nearly trough margins. So you have a stock that's coming off trough margins. So valuation might appear elevated, but again, margins are close to trough levels. So we think numbers go higher here, and that's going to help to propel the stock even further.
Corey, thanks so much for taking the time here. We're going to be looking forward to this report. We know you will be too.
Thank you.
Coming up, Elon Musk's AI startup unveils a new model rivaling ChatGPT and DeepSeek. What the new chatbot means for the intensifying AI race. That's next on Morning Brief. Elon Musk's startup xAI is debuting an updated AI chatbot tech. It's called Grok-3. According to Musk, the model has more than 10 times the compute power of its predecessor. And xAI claims it beats out OpenAI's ChatGPT, Alphabet's Gemini, and DeepSeek's V3 model on benchmarks measuring math, science, and coding problems here. So now we've got brouhaha that's forming in the chatbots for some of the major tech companies and billionaire investors who are putting forth all of them their own AI, generative AI chatbots right now.
Yeah, and we know that Musk and Sam Altman from OpenAI have gone head to head. Most recently have certainly been making headlines just about some of their disagreements. Of course, Musk just in the last several days, of course, offering potentially to buy OpenAI's nonprofit arm for just over $97 billion. Of course, OpenAI rejecting that, saying it wasn't an offer at all. So this, of course, just fuels and feeds into that back and forth between Musk and what we have heard from Altman. I wanted to show up, I want to throw up a chart comparing the effectiveness or maybe how much we should trust Grok. Now, this has not been independently verified here, but just in terms of how advanced this chatbot is compared to others that are on the market, and at least according to Musk, it is much more advanced or at least is more capable than what else is out there. Here we go. We got it up on the screen right now, just in terms of math and science and also in coding. You're seeing that green right there. The bright green is Grok-3 compared to some of its earlier versions. And then you also compare it to Google's Gemini, DeepSeek, and ChatGPT 4.0. So again, has not been independently verified, which is the most important thing to point out in this. But again, Musk and xAI very much saying that this should be and is the most advanced models out there. How much you can trust that, though, is a lot of questions. And that's what the street's debating this morning.
Yeah, you're taking a look at my squinty eyes going into some of the numbers here. And ultimately, I think what it comes back to is the people who have already started using some of these chatbots in one form or another, because that early mover, that first mover advantage plays a big role.
Yeah, it's hard to get people then away from that. All right, keep it right here. Coming up next is Catalyst. We'll be right back.